Welcome to this in-depth tutorial on portfolio management. Today, we will cover the fundamentals of portfolio management, including asset allocation, risk management, and performance measurement. By the end of this video, you should have a clear understanding of how to construct and manage an investment portfolio effectively. Firstly, let's define what a portfolio is. A portfolio is a collection of financial assets such as stocks, bonds, commodities, cash, and cash equivalents, including funds. Portfolios may be held by individual investors and/or managed by financial professionals, hedge funds, banks, and other financial institutions. The main goal of portfolio management is to maximize returns for a given amount of risk, or minimize risk for a given level of expected returns. This brings us to the concept of the efficient frontier, which is a set of optimal portfolios that offer the highest expected return for a defined level of risk. Let's dive deeper into asset allocation. Asset allocation refers to an investment strategy that aims to balance risk and reward by distributing a portfolio's assets according to an individual's goals, risk tolerance, and investment horizon. The three main asset classes are equities, stocks, fixed income, bonds, and cash equivalents. Here is an example of a simple portfolio asset allocation: 60% in equities, 30% in fixed income, and 10% in cash equivalents. This allocation may change based on the investor's profile and market conditions. Now let's talk about diversification. Diversification involves spreading investments across various assets to reduce exposure to any single asset or risk. By diversifying, you can potentially improve the returns of your portfolio while reducing its risk. To show the power of diversification, consider this. Instead of investing solely in one stock, you invest in a mix of 10 stocks across different industries. If one stock performs poorly, the other stocks can help mitigate the impact, stabilizing your returns. Let's get interactive. Which of the following options do you think represents a well-diversified portfolio? 100% in technology stocks. B. 50% in stocks. 30% in bonds. 20% in real estate. C. 80% in cash. 20% in gold. Think about it and pick the option. If you picked B, you are correct. Option B is well-balanced and diversified across different asset classes, which helps to reduce risk. Next, we will explore risk management in portfolio management. One common measure of risk is the standard deviation of returns, which quantifies the amount of variation or dispersion of a set of values. In the graph, we see Portfolio A has a higher standard deviation compared to Portfolio B, indicating higher risk. As investors, we must decide our risk tolerance and choose portfolios accordingly. Let's look at another risk management strategy: Value at Risk, VAR. VAR estimates the maximum loss a portfolio might face over a specific period for a given confidence interval. For instance, a portfolio with a one-day 5% VAR of $1 million implies that there is a 5% probability that the portfolio will lose more than $1 million in one day. Notice in the example above, Day 2 and Day 4 have losses exceeding the VAR, highlighting instances where the model's confidence is breached. An important aspect of managing a portfolio is continuous monitoring and rebalancing. Monitoring involves tracking the performance of your portfolio and the individual assets within it, ensuring they align with your objectives. Rebalancing involves adjusting the weightings of portfolio assets periodically to maintain your original asset allocation strategy. For example, if equities have performed well and now make up 70% of your portfolio instead of the intended 60%, you would sell some equities and buy other assets to return to your original allocation. The act of periodically rebalancing ensures your portfolio stays aligned with your risk tolerance and investment goals. How frequently should you rebalance? There's no one-size-fits-all answer. It depends on your investment strategy, market conditions, and transaction costs. Some investors rebalance annually, while others might do it quarterly or when asset allocations drift significantly. Another interactive question for you: If a portfolio's intended allocation is 50% stocks and 50% bonds, but due to stock market rallies, it changes to 70% stocks and 30% bonds, should you do nothing? B. Rebalance to original allocation. C. Invest more in stocks. Think about it and answer. The correct choice is B. Rebalance to original allocation. Rebalancing helps manage risk and keeps your portfolio aligned with your investment strategy. In conclusion, effective portfolio management involves a combination of asset allocation, diversification, risk management, and regular monitoring and rebalancing. By understanding and applying these principles, you can optimize your investment portfolio to achieve your financial goals. Thank you for watching this tutorial on portfolio management. If you enjoyed this video or found it informative, please like, share, and subscribe for more finance tutorials. Let us know in the comments below if you have any questions or topics you would like us to cover in future videos. Happy investing!